Hello, everybody. Peter Murphy and Chase Clark here with the Buying Tampa Bay podcast. Today's episode is all about the different strategies you can take when investing in real estate. And, we've talked about being a real estate investor a lot, and, we're big fans of the investment strategy. But there are so many ways you can invest in real estate. So which one is the right one for you? And how do you evaluate different real estate investment strategies to begin with? And what are the different risk and reward profiles associated with each strategy? Chase, you and I have some experience in lots of different strategies. So today we want to share a little bit about what we know, right?
Yeah, that's right. Welcome, everybody. And today we kind of want to get back to our roots, really, right? And talk about how we became investors and some of the strategies and experiences we've had that have taught us some valuable lessons along the way. So often I have young people coming up to me and asking me, what do I do to get started as a real estate investor? And that's an important question, because I remember back to when we were just starting out and we didn't know what we were doing. We knew what we wanted to do. We just had no idea how to do it, where to start, where to go, how to make it happen. And one of the things that was key for us in the beginning is networking, developing mentors, and talking with some of these people that had done it before, people that had experience, people that were willing to share what they had learned through the process and help guide us as we were getting started on our investment journey. And so that's a critical thing to do. If you're just starting out, if you're that person out there that wants to become a real estate investor, think about what you want to do, what your strategy is for investment, but most importantly, develop a team, develop a network of people that can help guide you to your end goal. There's nothing more valuable than that. And it's paid huge dividends for us. It helped us get started and launch our careers in real estate. And we're indebted to those people that initially helped us get over the hump and get our first deal done.
Chase, that's a great point. And, not to go too philosophical right out of the gate, but for me at least, unless I find that thinking and talking are like akin, and I don't really think through things fully unless I articulate them. And it's not just talking to myself, right? Because if I say stuff to myself, there's no one more intelligent than me to tell me that I'm being a bonehead, right? Or maybe that I have a good idea and I ought to run with that. It's literally talking to people about what you're thinking about investing in, the strategies that are at hand, is how you formulate your plans. And it's how you get great feedback from people. And it's not just one person you maybe want to talk to. It's more than one, because you need triangulation in conversation, don't you? You don't want to listen just to one guy who tells you this great strategy and it's his and only his, right? You need a third point and maybe a fourth to give you that full spectrum of what's the right thing for you to do. So by all means, talk to someone about this, and don't be afraid to sound stupid, because we all do when we're first starting, right? I mean, we all make lots of mistakes. We all don't know what the acronyms mean and what the phrases mean. It's a part of beginning anything, but it's so important.
Yeah, it sure is. And one thing you touched on, and one thing we'll explore throughout this episode, is how many different strategies there are. And even inside of those general strategies, how many different ways there are to accomplish your goal with that particular strategy. And so everything's based on your situation, your constraints, your risk tolerance, your availability of capital, your time available to invest in projects, or your appetite for being a landlord and doing property management and handling renters down the line. So all of that plays into what your investment strategy is going to be. But one thing we know for sure is after you have built your team and gotten the advice that you need to start, the first thing you've got to do is identify a property to invest in. And that's obviously the first step. If you're going to be a real estate investor, you've got to own real estate.
Yeah, it's not too obvious that you said that, because there's a whole lot of people we talk to that never own real estate. They just like to talk about it. They're like failure to launch, in real estate. They love the idea of being an investor, but they just cannot envision how to actually make it happen. They can't press go, right? And those people are, so frustrating in a way to talk to, because I'm like, your theory is right and you're right on the verge, but you just can't identify the property and make that commitment. And there could be all kinds of reasons for that. They might not be able to get their liquidity, their cash together to actually make the investment. They might be just so risk averse they can never actually try and do something. My suspicion is that there's lots of areas of their lives that are like that, not just the real estate investing game. You can identify that right out of the gate. And maybe for listeners, if you're the kind of person that's got lots of starts and no finishes in your life, or lots of things you want to do and you've never tried them, look in the mirror a little bit about that and allow that to be, kind of an important self-actualization moment. This is talking about something is great, but you must actually invest. Take the risk, and the rewards to those who take the risk are huge, but you must make that purchase decision. So, hey, how do you make the purchase decision? Where do you find good product?
Well, that's an interesting question, right? Because I think so many people come into this thinking that this is a big mystery, right? It's like real estate investors live on this other planet somewhere. And, I don't know how to break through. I don't know how to find the properties they find or find the deals that they get, Hopefully we can demystify a little bit of this for you, because it doesn't have to be that hard. In fact, the place that we went when we bought our first investment property was to a real estate agent who had access to MLS. And that's where we bought our first duplex that we executed a buy and hold strategy on. And so it can be that easy. It can be as easy as finding a realtor that works with investors, if you're not an agent yourself, and have them help you find a property that's listed out on the multiple listing service, and go with that property if the numbers make sense for you.
Yeah. Maybe our listeners don't even realize, but there's a category of real estate inside of MLS called income properties, called investment properties, right? And you can have your realtor execute a search for you of homes that are being listed by investors for their income potential. Now, of course, that's going to direct you down one of those strategies that folks tend to focus on. That's the guys who want income from an investment property. But there are entire categories of properties on MLS that are classified as that. And your realtor, if they're any good at all, will be able to also identify which properties are in the single family segment, which might be perfect for different kinds of strategies other than just income. That's where they're spending their time all day. So they're a great person to start with.
Yeah, that's right. And what's interesting is when we used to talk about traditional sources of finding real estate deals, MLS was all we talked about, right? And so you had to get a real estate agent who had access to MLS to kind of get you in on that, right? So then Realtor.com came along, and that was supposed to kind of mirror MLS, but not exactly all the time. But with the proliferation of Zillow and things like Facebook Marketplace, people are listing properties now in all kinds of what are becoming more traditional methods. And a lot of times they're by owner. Sometimes they're syndicated listings from real estate brokerages. But there are other places where you can go if you feel comfortable with what you're looking at, and find properties on Zillow or Facebook Marketplace or some other places like Craigslist even. But the one thing you don't get when you go it alone, especially if you're starting out, is you don't get that expertise and that advice that you might get from a seasoned agent who has worked with investors in the past. So beware of that one caveat. But if you feel like you've done your homework and you know what you're looking at, there are some other what we would call traditional sources for properties to invest in.
And you said a seasoned investor realtor. Let's make sure that our listeners understand, I think, this reality too. A good investment realtor is going to give you some guideposts in which to make that investment, some parameters under which they have seen investments work. But they're not going to tell you, Chase, this is a great investment property, you should buy it. Because, if they really felt like that, they'd buy it themselves, right? They'd find their own money and they'd buy it. I think everyone has there's general enigma around what makes a real estate investment pop for each individual investor. And like Chase said earlier, there's a variety of factors that influence that. Some folks like certain kinds of houses in certain areas and certain construction standards or vintages. Some like minimum bed counts or minimum bath counts, or, there's all kinds of factors that might make an investment right for you. But your realtor will be able to give you some guideposts and guidelines. They're going to leave that ultimate decision and saying, this is the one I want to buy, up to you. And so you've got to be courageous enough to take that first step based upon what you envision to be the best investment for you. And based upon that conversation you've had with your mentors and your feedback agents. All of those things are going to be so important. But ultimately, that decision to make that purchase, that first purchase, is going to be entirely on your shoulders. And there couldn't be a better time for that to be the case, because there's so much great information available to you. And not only is there product available in these very conventional sectors, but there's all kinds of off-market sectors to find product too, right? I mean, we've used some of those before too, right, Chase?
Oh, that's right. Yeah. I mean, you've got all kinds of investors out there, and we primarily refer to them as wholesalers, if you will. And, these guys have found properties, they found deals on properties through their own grassroots marketing efforts, and they've marked them up, 10, 15, 20, sometimes even $30,000. And they've put them back out on the market through their email blasts, their own websites, text marketing, email marketing, whatever method they choose, at those higher prices to sell to other investors who can come along and buy them and still add value to the equation. And so there's plenty of these email lists floating out there. In fact, I think I probably get 10 or 12 of them a day. There's wholesalers all over the place. No matter what market you're in, I'm sure you have a wholesaler in your market that is out there knocking doors, sending out flyers and postcards, cold calling people and texting people, trying to find deals that they can in turn wholesale to you at a higher price. And so a lot of times those are the best deals because there's no friction costs involved in terms of commissions to real estate agents. A lot of times these guys have found sellers that don't want to go through traditional methods and are willing to take less money than maybe they could get if they put their house on the public market. And so a lot of times you'll find your best deals coming in what we call off market, right? They're not listed on the MLS. They're not going to be on Zillow necessarily or any of these other very common public online forums in which you would find real estate for sale.
Yeah, and these off-market deals, the reason why they're so attractive in pricing, right, in so many cases, is because the product themselves are generally not financeable by traditional means. What you find on Realtor.com and on the MLS tends to be product that can be purchased with some kind of financing structure, some kind of conventional financing structure, which requires its condition, the major mechanical elements, the 4-point inspection that we've talked about before, which requires those 4-point categories to be at a higher standard. And if someone's trying to sell a home that doesn't have that in place, it's got some obsolescences, it's got a bad roof, maybe old electrical or a bad AC, they cannot ask a market price for that home. And they cannot, in lots of cases, even sell it in the traditional exchanges because no buyer could buy it without financing. That's where the wholesaler sweet spot is. And that's why they add so much value to the marketplace because they bring properties to investors that investors have to buy with cash or with cash equivalent financing. Now, cash equivalent financing is a complicated idea, but the idea there is that there's people there who will lend money in what's a hard money fashion to investors to buy these non-qualifying properties, right?
Yeah, that's right. And, when we talk about that too, a lot of times these properties, even though they can't be financed with traditional bank methods and they need hard money or private money, the numbers still work. Even when you're paying higher interest rates or you're paying points up front to a hard money lender, a lot of times the value that's being created by what the wholesaler offers makes it so that there's room in the deal to pay some of these other costs that they know are going to come along. So wholesalers know that when they offer the property up, and they know there's a high cost to you using your cash. There's also a cost to you using private money. And so that's all kind of got to be baked into the deal. You better bake it into the deal because if you don't, you're going to end up paying too much for the property. And that's the first cardinal sin of real estate investing is never pay too much for the property. But we'll get onto some of these financing things here in a minute in a little bit more detail. But one other method I want to talk about real quick from an off-market perspective is that what wholesalers do, what we just touched on a second ago, in their marketing efforts, over time, as you become more experienced as a real estate investor, you'll become aware of some of these techniques and how to master these techniques and use them yourself to find your own properties independent of some of these wholesale methods that are readily available to you. That's anything from sending out postcards to targeted areas where you think there might be sellers willing to sell below market, flyers, emails, snipe signs. So, code enforcement's going to give you a nasty gram, but you probably haven't been able to drive through town in the past 10 years and not see what we call a snipe sign, some kind of handwritten looking sign on the side of the road saying, I buy houses, or we buy houses, or Johnny buys houses, or whatever the case. Call that phone number. That guy's probably got some good deals. But you can put your same sign out, under certain circumstances in certain municipalities and get those same leads that wholesaler is getting if you have the time and the ability to do that kind of thing. So a lot of different methods are available to you, but sometimes there's a cost to each of them. And so whether you pay a wholesaler $10,000 for the property he can bring to you right away, or you spend 100 hours of your own time finding a deal, there's a cost involved in both. Some work better for others, and some, will choose to go the easy route with the wholesaler.
Yeah, that's right. And I know that you're going to be skeptical that these kinds of methods still work in today's day and age. And, and I am every time a snipe sign goes up and someone calls on it, I'm amazed they call on it. I truly am, right? I'm like, what are people doing calling on my sign to sell their home to me? I mean, that seems so unlikely in this kind of day and age, but they do it. And they respond to your phone calls. Back in the time where you could do texts, and that's probably ill-advised right now because there's so much action against do not call and do not text. But you could send a text or a call out, and people would respond all the time to say, yes, I want to sell my house. It's not in great shape. I can't go through a realtor. I don't know a realtor. I mean, that always blows my mind. I mean, I know 1,000 realtors. I practically have a bunch in my family, right? You probably do too, Chase, and who doesn't, right? But someone out there doesn't know a realtor, and they call you when they get your postcard or they get your mailing or they get your text. Or how about this? You go and post on your neighborhood app that you buy houses, and if someone needs to sell their house real fast, you can buy it from them. And lo and behold, someone is going to call you, and it's going to shock you when it happens, but they will. And that is how you get off-market deals.
We'll be back after a quick break.
You hear a lot about supply chains these days because if the past couple years have taught us anything, it's that an efficient, well-managed supply chain is absolutely critical to keeping businesses successful and consumers happy. I'm Will Haywood, and I host a podcast called All Business, No Boundaries, where we talk about supply chains, how they work, what happens when they don't, and the innovations that are redefining what's possible in the world of logistics. Listen and subscribe wherever you get your podcasts.
Yeah, so, once you've secured a property or once you've found something, whether on market or off market, that you think you want to go after, you've got to have the resources to buy it, right? We've already talked a little bit about how stuff that's traditionally on market, sometimes you can just go get qualified for a regular residential mortgage or a commercial mortgage if it's a multifamily rental property, and get that financing and have a traditional closing where you bring a down payment, pay your closing costs, and the bank funds the majority of the deal. For the off-market stuff and the stuff, honestly, that's going to be a better deal for you long-term at a lower price, or a property where you can add the most value long-term to it to create equity for yourself, is going to be off-market. And so how do you fund this stuff, right? Outside of traditional banks, we've got private money, right? Private money can come in what I feel like are two different forms. One is hard money that we talked about earlier, and it's only hard money because it's expensive, and sometimes it's hard to choke down how much it costs, right? You may be paying 2 or 3 points up front, which is 2 or 3% of the loan amount up front as a fee, and then you may be paying anywhere from 10 to 15% annual interest on that money. You may also have a deadline in which to pay it back that is 6 months out. So you got to move quick, right? Because they want their money back so they can turn it to the next guy that'll give them 3 points up front. That's why it's hard money, okay? Not necessarily bad money. Sometimes it's really good money, but it's still a little hard because it's expensive. And what I feel like is the better form of private money, which is me calling up Peter and saying, hey, man, tap into that cash vault you got and loan me 100 G's because I found a great deal on a condo here. That money is friends and family money, right? Friends and family money, okay? Your friends and your
that's
family,
easy money.
Yeah, easy money. Right? They have more money than you think they have, somewhere in your family tree. And they probably find you to be fairly trustworthy. Hopefully they do. And you're able to give them a market rate of interest on their money when you borrow it from them. And it can create a good synergy. It's a great place to go to get the money. It helps them create income from money that may not be generating income for them right now. And it helps you fund a real estate deal in a very non-traditional way, but a very friendly way to you. So I love using friends and family money. It's been great for us. We've both done it. It's helped us do quite a few deals over time. And it's a great way to go if you have that resource.
Yeah, I can't even believe how hard money got that name. I mean, every time I go to use it, I feel like I'm hard up, so I need to use hard money. That's not what it means, right? You're probably using it because, well, you're getting ready to be the least hard up person you know, right? But like Chase said, it's just expensive and it's costly because you need it in a hurry, right? And so, well, maybe that's the reason why it's called hard money. But it's an absolutely wonderful option, and don't let the name deter you from using it. It's available. You just need to work the cost of this money, no matter what it is. Maybe it's your easy friends and family money. Maybe it's your expensive hard money. Which are any of these right for a deal? Well, sure, they're right if they work, right? If the numbers work when you evaluate the interest rates and the points that you've got to pay, and maybe the prepayment penalties in some case, and if it's available when you need it in order to buy the home. And that factor is what can make or break a financing decision, because conventional financing can take 30, 60, 90 days to pull together. Maybe your friends and family need to cash out some mutual funds or CDs, and they can't do that until the beginning of the year. But hard money is available right now for a cost. And if that cost works within your pro forma, within your investment budget, then that's the right choice for you, even if it seems like it's going to cost a lot of money. So don't be scared of it, for sure. And of course, don't be scared of your own money, right? Maybe you've got some money lying around in your bank account. Maybe you've got a 401k or retirement funds that you can tap into in some kind of cash-free or low-cost mechanism. Or maybe you already have some equity in a piece of real estate right now, your primary residence. Your primary residence is sitting there, and over the course of the last who knows how long has been accruing value with a fixed debt obligation. And so your equity in that property has grown and grown and grown, and it's sitting there doing almost nothing. Now is the time to put it to work if you've got a great investment option. That's your own money, and it's a great thing to tap into that to make an investment decision.
Yeah, that's right. And you've got several sources, right? So we got banks, we've got private money, and we've got your money, right? And so the last thing to think about before we pull the trigger on a closing date maybe is this actually a good property to buy, right? That's not what we're addressing today. We're going to address that in a different podcast, is to tell you, okay, how do we evaluate properties we find to determine whether or not they're good investments or not? Today, we're talking about strategy. But we've developed over the years a great Excel spreadsheet that we call Real Returns that we will cover in another podcast and be glad to share with those of you who are listening to the podcast so that you can better determine whether or not a property is actually a good property for you to buy, right? But now we want to shift into, okay, what do we do with this property, right? We've determined it's a good buy. We're going to closing on it. Well, the strategies we want to cover today are, do we rehab this thing and turn around and sell it again? Number one, right? That's a fix and flip, right? We're going to fix up a house. We're going to sell it. We're going to flip it. We're going to make a profit and go on to the next deal, right? Or are we going to buy and hold, right? Buy and hold is, hey, we're going to buy the house. We're going to fix it up. We're going to put a tenant in the house, and we're going to hold it long-term and collect this stream of cash flow while rents hopefully go up and housing prices go up. And then 30 years down the road, we'll have a mortgage paid off, we'll have a house free and clear, and we'll have a long-term equity play on a wonderful cash flowing asset. All right, so those are the two things we want to talk about today as far as strategy goes with what do we do with this property.
Yeah, and there seems like there's two kinds of people in the world, doesn't there? People who like fix and flip, and that's their thing, and people who like buy and hold, and that's their thing. And I don't know, man, but in my experience with working with investors and everyone I run into, I mean, my goodness, people fall firmly on either side of that equation. I've got all kinds of questions as to why that is, because both of them seem to have a place in a good investment strategy. But I mean, personality profiles, like I can meet someone, I can know, oh, this guy is a fix and flip guy, 100% all the way, right? And then I meet this buttoned up accountant and I'm like, yeah, buy and hold all day long, right? So, so what are those things? I mean, what are those things that like drive some of the difference? Like, why do people choose one strategy or another? I mean, is there something in your mind that stands out?
Well, not to stereotype anyone, but usually it has to do with the cost of the vehicle they're driving, right? I mean, how often do we pull up to properties and someone comes up in their Lambo or their, tricked out Hummer and, there's the fix and flip guy, right? He's not the buy and hold, right? Now that doesn't go for everyone, but so often, why is that the case?
I mean, I don't know, it's a risk profile, right? I mean, like high risk, high reward people, right? They love this fix and flip strategy. It seems to appeal to all their senses, right? And it's flashy and wow, I just made $100,000 in like 1 week. And that's kind of like the profile of the guy who loves fix and flip. I mean, there's a place for that. I love making $100,000 in 1 week sometimes. Sometimes I really need that. But, there's also some real risk associated with that strategy too. And I think you've got to have a high risk tolerance to play that game. And man, maybe that's exactly what this is. It's just the higher the risk tolerance, the more prone someone is to play in the fix and flip arena. They're having to tap into a certain kind of money and a certain kind of strategy and a certain type of time horizon to make fix and flip a viable investment for them. And a lot of that's more short term. And that, again, is more closely equated with higher risk and less room for big mistakes. So maybe that's some of what that is. But I think the car test is a good one. We've run with that a few times.
Well, it's definitely fix and flip is definitely, at least on the surface, it appears to be more risky. You're dealing with high dollars, short timelines, and very little margin for error, right? You've got to recoup your money and make a profit in a very short period of time. So that means you've got to call all the right shots, right? You've got to, number one, pay the right price for the property. You've got to nail the rehab, make it exactly what buyers want. You've got to get a buyer quickly for it to minimize your holding costs. And then you've got to really hope that the appraiser agrees with your assessment of the market value of this renovated home so that you can maximize your profit and get out of it what you thought you were going to get out of it on a sale. So there's a lot of different things moving in a very short period of time there to make a fix and flip strategy, bulletproof, if you will.
My experience with the fix and flip strategy in a big way illustrates some of its both huge opportunities, because there's periods of time over which guys who work fix and flip make wonderful short-term cash. And that short-term cash can be used for reinvestment of all kinds, right? In all kinds of different strategies. If those guys can pivot from a fix and flip strategy, if you can pivot in your fix and flip strategy into a buy and hold, because that's what you needed to do to get that war chest, that substantial war chest to make good long-term buy and hold decisions, then great stuff. It has a wonderful place for you to really build those cash reserves. So you can make, so you can use your own money instead of someone else's money for all your buying decisions. But the housing market crash of 2008 and 6 and 7 and 8 was driven, like flippers played a huge role in that, because there came a time where guys who are buying homes to flip quickly just weren't able to flip them. The market corrected so rapidly that their projections for what they could sell that home for were way off. They were just higher than what you could actually sell the home for. And so they found themselves underwater, just like everyone else, very rapidly, and in a position where none of their evaluations of return were going to work for that fix and flip strategy. And the challenge of the fix and flip strategy, of course, is that it usually doesn't contemplate any kind of rental component. So you might have purchased the home at a certain valuation, spent a certain amount of money on rehab. You haven't even thought about whether or not the cost of that investment can be buoyed up by rental income over time, because you're not even considering it that way. And so when you finally do apply a rent rate estimate to that home, given the cost of funds and what you spend on the property to begin with, you might find that rental just cannot support that fix and flip investment. And so you're forced to sell it, or you're forced to short sell it. And of course, those can be risky things. But we don't want to like just totally dump on the strategy, because there's some really good things that come from it. And the cash flow that comes from a fix and flip strategy, the immediacy of your income, I mean, it's unparalleled. And like I said, making $100,000 on a single deal in 1 week is entirely possible in the fix and flip category if you buy right, and if you're in a market which will tolerate those kind of real big income opportunities.
Yeah, and some markets just aren't good for rental. We've got some friends that live in rural areas where there are a lot of fix and flip opportunities, but it's just not a rental area, right? Rural areas tend not to be as much of a rental area as more of an urban or a suburban area is. And so if you're living in a more rural area, fix and flip may be the best strategy for you, because it's difficult to rent at the kind of rents you need to rent for to cover your cash flow. And so that can definitely be one consideration, and you kind of shifting your strategy more to fix and flip than to buy and hold. The other thing is with the fix and flip strategy, not only do you free up your cash flow quickly to be able to do alternative investments, but you also have the ability to take a $150,000 check at closing and post it on Facebook and say, hey, look, I'm a real estate investor. Look what I did. I'm the real thing. $150,000 check from closing, right? It's like, it goes right along with the whole car thing. And I don't want to paint all fix and flippers in this kind of a light, but quite often, it's that validation you get, right? It's that short-term gratification, but it's validation that, hey, look, I set out to do something. I picked the right house. I rehabbed it well. I found the buyer. I nailed the market valuation, and man, look how great I am, right? Look what I did. This is great, and it does give you that validation that sometimes you need as an investor, especially starting out, because you want to feel like, hey, I can be successful at this, and you do want to build your war chest. The only thing to be careful of is, remember, when you fix and flip a property in under 12 months, you are paying ordinary tax rates on that profit. It's not a capital gain. So if you walk away from closing with $150,000 profit check, just remember, probably $45,000 of that is going to go to the IRS. And just be prepared for that, because that's one big difference when we talk about the numbers in the financial strategy of flipping versus buy and hold. And buy and hold doesn't have to be forever. Buy and hold can be a deferred flipping strategy, right? You can buy it and hold it for a year and then flip it and pay capital gains tax, which is far less than ordinary income. So within these two strategies, there's even a hybrid like that you can play on. And so lots of ways to skin the cat here, but fix and flip, very attractive for lots of reasons, mainly because of the short-term cash flow cycle, the instant gratification from making a big hit on a deal, and for the flexibility it provides you going forward.
Those are great points. And I do want to stress the validation, the proof of concept one, because it's such a good one. And if your strategy is to prove to the marketplace that you have the ability to buy their home fast and hassle-free, and you can do a deal, well, there's a whole lot of people that want to work with you. And so you're doing it because you want the confidence builder and the attaboys that you get from doing that deal. You want the reinforcement. All that's good. All that's important for what you need as an investor, because you're not going to get a lot of that out there, right? But you're also doing it so that people will continue to use you, continue to trust you, and continue to try and sell their house to you because they know that you get things done. So that's one thing. The second thing I will say, that we talked about rural areas and why that's so important and helpful for a fix and flip strategy. But let's also think about a certain mentality right now that exists commonplace in our market. And that is that people want a house that's move-in ready to move into. So I've seen some homes in the luxury segment lately, which have floors that are like 5,000 to 10,000 square feet of ceramic tile from the 80s, right? This is a luxury house, gorgeous in so many ways, perfect in so many ways, but it's going to require a huge effort to get those floors right and a lot of money, right? Here's someone who needs to sell a house. Here's to a flipper. A flipper needs to come in, buy that house at a substantially discounted price if they can, because the floor is going to require $100,000 in flooring and all the labor and all the upheaval to your life to actually make that happen. Buy the house, replace the floors, sell, whatever, modernize and upgrade whatever other things within that home that need to make it appropriate for a luxury buyer, and maximize your potential sale price. If your margins work, that's a perfect flip strategy, because people buying a luxury home do not want to roll their sleeves up generally and demo tile. That's what flippers do, and that's why flippers make great money. So look for those kinds of opportunities, no matter where you are. There's certain kinds of homes that are ideally suited for someone to come in, buy them, and flip them. And that luxury segment could be prime, or in that entry luxury segment could be prime for some of that flipping activity right now.
Yeah, definitely. And so I guess that begs the question, right? So we've talked about fix and flip. So why buy and hold? Why would you even consider buy and hold? I mean, we talked about the tax strategy, and that's definitely one advantage to buy and hold over fix and flip, because you're going to pay far less taxes on profits. But why else? Why would I want to buy and hold on to an asset? Why would I want to become a landlord? Why would I want to have to hire a property manager? Why would I want to have to deal with tenants? That seems like a whole big hassle compared to the fix and flip, where it's transactional, right? I buy a house, I get in, I get out, I get a paycheck, right? With buy and hold, I get in and I'm in and I'm in and I'm in, and I don't necessarily know if I'm ever getting out, right? What's the deal with that?
Right. I mean, it's like, it's endless. Your gratification is so far deferred that do you ever receive the gratification? I mean, I am a buy and hold guy with the bulk of my portfolio. And I will tell you, yes, you feel that all the time. It's like, that on paper, you've got a lot of money and you've got tons of equity in properties, but you feel poor, right? I mean, because what do you do all day? You write checks and spend more money on ACs that fail and turnovers that have to happen. And maybe over the course of time, you start getting some cash flow for those investments. And hopefully, if you've played your cards right, that becomes substantial enough to pay some of your living expenses. But you never feel rich in that strategy, at least not until you until you recognize the earnings. But I think the idea there is that here's a strategy that builds equity for you long term, right? I mean, that very much is a mentality. That's an approach to life, right? It's very appealing to certain people, that I'm going to forego whatever kind of short-term gratification that could appeal to me, that does appeal to me, because I believe that the equity that I will build over time in this strategy is greater than, and will provide me a greater reward than, the short-term hits that I'm going to get from a short-term investment strategy. And that equity building is unparalleled in the buy and hold strategy. For those of you who need that kind of reserve for your retirement, you're not independently wealthy, you don't have a trust fund, this is the vehicle that you use to build long-term wealth for your estate, for your family, for your wife and kids and grandkids. And the verse that flows through my mind all the time is the proverb that tells me that a wise man leaves inheritance to his children's children. And that's what I'm trying to do, right? I'm trying to put my family in a position that no one in my family has ever been in, right? Well, not that I know of. And I want to be that kind of a wise man. And I think there's real value in that for me and for my family. That's one reason why folks do it.
Yeah, so it's a lot different than the fix and flip strategy from the standpoint of it requires endurance, right? It requires patience. It requires a different mentality, right? It's a long term. It's a long game mentality, right? It doesn't have to be long forever necessarily, but it's got to be a lot longer than that, 90 to 120 day fix and flip timeline, right? And one of the most important things to keep in mind is that, you make your money when you buy the property, right? Not always when you sell it. Even though when you sell it's when you get the cash, you make your money when you buy it, right? So some of this requires a shift in mindset to, okay, well, what do I have invested in this home? And how can I best maximize my return on income, my return on my cash, my return on my equity with this asset? Sometimes that is fix and flip, but quite often, and probably more often than not, when you look at the numbers over any considerable length of time, buy and hold is the way to go. because not only are you earning a cash flow stream over that course of time that you're holding the asset on that investment you've already made, but you're building equity, either in the fact that home values are rising, or the home is definitely worth more than what you paid for it and will continue to rise over time. Or even if you took out a loan, 100% loan of whatever the purchase price was for you to acquire that property, you've got a tenant in the property that is creating equity for you every month by paying off your mortgage, right? So every time you get a rent check and you're still paying the mortgage to Bank of America or whoever it is, part of that rent check's going to that mortgage, but who paid that, right? The tenant paid it, right? Tenants are building equity for you every time they pay your rent. So there's a shift in mindset involved, but when you crunch the numbers out over a long period of time, there's a significantly higher ROI with a buy and hold strategy than a lot of fix and flips, even though sometimes your fix and flip return may be 5,000% because it was done over a 90-day period. Well, if you extrapolate that over the course of time, you're still going to, in theory, get your flip profits. When you go to sell that asset one day, at the end of the day, you're going to get profit on whatever the place is worth over what you paid for it. Remember, because you made your money when you bought it. Okay. Plus, you've got the cash flow stream for 5, 10, 15, 20, 30 years where you're pocketing positive cash flow every month. And so hard to beat that, right? You can't duplicate that really in the stock market. It's akin to a dividend stock, but I haven't seen any dividend stocks that pay out the way buy and hold rental properties do.
Yeah, nowhere close. In fact, it just seems like that once that portfolio is built, that stable annuity that's paid out from your rental properties becomes very attractive. Now, we don't want to leave the impression that you can't accomplish a similar rate of return by a series of frequent flicks and flips. If you're able to make that 500, that 5,000% return on your money, flipping a home every month, then wow, that's very attractive. And that's going to be a hard to beat scenario. But what anyone who's been in the fix and flip environment knows is that it's very hard to sustain that kind of activity. Market dynamics change so often that it's hard to create a model, an investment model, which is constantly feeding itself in the fix and flip arena, which is why eventually even fix and flippers have to add buy and hold components to their portfolio, because you can't always buy a house that's going to yield you a 5,000% return, but you can kind of routinely buy a home that yields you a 6 or 7% return. And you can do that over lots of different types of properties to give you a type of diversification, over lots of different renter demographics to insulate you from peaks or troughs in different demographic sectors, in different markets to give you insulation from what might be a recession, a local market recession. And so you really can duplicate some of the risk dilution that you get in a mutual fund with a very diverse buy and hold portfolio of assets. And that is a big part of what makes all of this so attractive. Not to mention, of course, the tax advantages that exist for that kind of strategy. There are all kinds of reasons why a preferential tax treatment for this kind of income and for that kind of a long-term buy and hold strategy that makes this just an attractive way to invest. Yeah, there's a certain mentality too, I think, that's necessitated for someone who plays well in that sector. And that is that the future is going to be better, right? That America's future, the future and the value of your home in your local municipality is going to be much better in a few years from now than it is right now. And that must be the case for a buy and hold strategy to succeed, right? You can't be buying in a market which 10 years from now is going to be worth less. If your market looks like that, that is not a market for you to do buy and hold in. That's a market for you to do calculated fix and flips and get out as fast as you can, because you don't have the assurance that 10 years from now, you will have experienced 10 years of appreciative gains on your asset. That is a required necessity. So either you're a believer in that reality for your local market or you're not. And if you're a believer, buy and hold is the right strategy for you.
Yeah, diversification is so important, no matter what type of investment you're undertaking, and whether that's diversification of strategy, or if you've got a buy and hold strategy, diversification of the type of properties you own, where you own them, and mitigate your risk as far as what your tenant base looks like and what your asset base looks like. Now, within this buy and hold strategy, there's a very popular subset of this strategy that has been promoted quite heavily by the guys on Bigger Pockets. And, I'm a fan. I listen to the Bigger Pockets guys. I think they've got a lot of good insight and a lot of good things to offer. And one of the strategies that they promote continually is what you've probably heard called BRRRR, right? And it's not like BRRRR, like you're shivering from the cold, but it's the BRRRR, BRRRR, right? Buy, rehab, rent, refinance, and repeat, right? Interesting, BRRR, BRRRR, interesting acronym for that. But this is an interesting hybrid of what I feel like is a hybrid of buy and hold and fix and flip, because it allows you to have a buy and hold strategy where you recoup your investment before you have to sell the home. At least that's the idea and the strategy involved when trying to execute on BRRRR, right? It's the idea that you can buy a property, renovate it, rent it out, and with your rent, have enough cash flow to make a mortgage payment. Because what you're going to do is you're going to refinance this property. You're going to go to the bank after you've renovated it and after you've got it rented, and you're going to say, hey, look, I want to get a 70% loan to value mortgage on this property. Ideally, you want to get a 30-year loan, fixed rate, lowest possible payment, so that you can still maximize the margin on your cash flow between the rent and what your mortgage payment will be. But what you're doing then is you're cash out refinancing the property and taking all the money you initially invested in this property back off the table, putting it back in your pocket so that you can then repeat the process with those dollars and invest in a new home that you can do the same thing with the next time, executing on the BRRRR strategy. So very interesting concept, What are your thoughts about that? Because I hadn't really thought about it in this kind of mechanical kind of process type way before, even though this is exactly what we've done, right?
Right. Yeah. We haven't labeled it. I wish we had. These guys are brilliant, smarter than us, right? So they put a great package on this, and of course, this is what many good investors do: is they take a line of credit out, they refinance in some capacity or other their investments in order to tap into their equity, because they don't just care about return on investment, on what cash they put into the property. They care about return on equity, right? And while your equity is all tied up in your home, like we talked about a little bit earlier on, use your own cash to invest in the property, right? Because you've got all that equity growing and the equity is doing nothing, right? Maybe you've got a huge amount of equity in your investment portfolio or in your private residence, and it's just sitting there, and you like the idea of that. It makes you feel good. It makes your wife feel good and nice and secure, and everyone's happy with that. But the return on that equity is abysmal. And are you being the best steward that you should be with that equity? Well, this BRRRR strategy really helps you right size your return on equity. It helps you put that to work. And you do it in kind of a safe way, right? Because traditional financing doesn't let you overexpose your equity, right? Your refinance lender is going to make sure you still have sufficient debt to equity, that you still have a sufficient spread in your property, so you're not borrowing so much against your collateral, your house, that if there is a market correction, you'll owe more than the house is worth. They'll protect you from that reality, especially in a 70-30 debt to debt strategy. That 70% means they won't let you borrow more than 70% of the total value of your asset. That will protect you against a market correction of 30%, which is not likely to happen in most of the markets we're in right now. So with that protection, and with the ability then to access that equity and put it to work, then of course you can see that compounding effect of your investment dollars. Both the investment is working and your equity. It's a very smart strategy, and every investor should consider how to do it.
Yeah, some people might call this strategy, right, playing with house money, right? Because once you've recouped your initial investment or your cash that you've put into the deal, you've not only freed up that cash flow, but you've got a lot less risk in this investment, right? And so the ideal way to execute on this BRRRR strategy is to make sure that whatever you pay for the asset, plus whatever your renovation or rehab costs are, sums up to 70% or less than what the market value of that property will be after you rehab it. That allows you to get the most out of your investment recouped to you from this refinance loan. All right, because remember, they're going to loan you 70% of the market value. Okay, so if you have only 70% of the market value invested in the property, you're going to get 100% of your investment back. And that's critical. It's critical because cash is king. We've heard that slogan or that cliche, over and over again, but it's true in real estate. Cash provides flexibility to you. It provides opportunity to you. And so if you can recoup your cash from a buy and hold strategy and turn around and use it to build your portfolio, you're going to be far ahead of the game than most investors, because you won't have to be going back to tap so much hard money or private money. And you can do 10 loans like this that are backed by Fannie or Freddie, right? So Fannie Mae, Freddie Mac, those are the mortgage insurance bond agencies that back most residential mortgages. If you're dealing in single family homes, you can take out up to 10 of these traditional 30-year fixed loans with a regular bank. And so you could build a portfolio of 10 properties using this particular strategy without having to go to the commercial side or deal with other types of lending that might be available out there, and build quite a nice portfolio, not only for cash flow purposes, but for long-term equity. Because in 30 years, these homes will be paid off. And if you're here in the Tampa Bay area, where the average price of a single family home is getting up to, high threes, if not low fours, 10 properties is almost $4 million worth of real estate. So huge number for a lot of people, and definitely an inheritance that can be passed on to your children's children.
I like it. There's some challenges associated with this strategy right now, right? I mean, we're in an interest rate market. Man, Chase, we're going to be doing market prognostication in our next podcast episode. But man, I have that whiteboard in our office, and the numbers we have slapped up on that whiteboard for what the interest rate will be, the average interest rate for financing. And like, we were sitting at the start of the year saying, there's no way it will get, I'm not going to give it away, right? But we're way above what we thought would be the high point of interest rates on loans right now. And so here we are in an expensive money market, and we have a refinance strategy which we want to employ, right? We know that we need to have our interest rates as low as possible, our payments as low as possible, in order to keep cash flow positive. Because if we're going to enter a refinance strategy, we don't want to get into a strategy where we're paying money every month in addition to our rental income to cover our debt treatment, right? That doesn't make sense, right? So what do we do when we're in a market like this one, where our goal is to keep that rent payment, that mortgage payment as low as possible, but we're dealing with high interest rates? How do we make refinancing a part of our strategy? And what's the right course of action for people to take as they think about incorporating this?
Well, right now in Tampa Bay, we just increased the rent, right? It's like, it seems that every time I turn around, I'm talking to a renter who's like, my landlord just doubled my rent. I'm like, oh, they must be a fan of the BRRRR strategy. But in all seriousness, right, we can't just rely on increases in rent to continue in the fashion that they have to be able to afford these mortgages. And so timing does become critical, right? Maybe you don't refinance right now. Maybe you let your investment in this deal ride for another 4, 5, 6 months, because what we're hearing at least still is that, Fannie Mae is predicting in the springtime we'll have rates back closer to 5%. And at 5%, the deal makes sense. But I think today the 30-year fixed nationwide average is like 6.7, right? So 6.7 versus 5 is a couple $100 a month, right? And maybe now doesn't make sense. So there is a timing element to it. It doesn't always work in the moment, depending on market conditions, right? And I think when we talk about risk factors in general for investing, no matter what asset you're investing in, there's always a market factor, right? In real estate, the price of real estate doesn't fluctuate quite as much as like the stock market per se, because there's more friction costs in the transacting of real estate. And so it's a little more forgiving from that standpoint than it is from day to day in the stock market. But we're subject to interest rates, right? Interest rates do change quite frequently. And oftentimes they do ebb and flow with the stock market. And so if you are taking on debt, that is one of your biggest risk factors is market, right? It's market interest rates. And in addition to that, it's market rents, right? If you're in an area where there's a large employer and a lot of your tenants work for that employer and they just went through a round of layoffs like several large companies did, you've got market risks there because you may not have the same tenant demand next year that you had this year. You may have to come down on your rent prices. You may have extra days of vacancy. And so there's definitely market risk in every aspect of investing. In real estate, it comes on several different fronts, but definitely comes in the form of interest rates.
Right. So you're gonna have to potentially put a hold on your strategy if you're in an interest rate environment where the economics of that refinance won't work out. But so much of real estate investing is patient money, is making sure that you're in it for the long haul. In the buy hold strategy, the essence of it is patience. Allow the market to inflate, to accrete over time. Allow someone to pay your mortgage over time. It's like 30 years, but that's a long time. But over that period of time, a lot can work itself out. You can have interest rate adjustments. Maybe you have to refinance now at 6 3/4, but you can refinance again in 2 years when those interest rates come back down into the 4s again, which they quite probably will. Right. And that will lead to a very much a right sizing of that investment for you. So think long term, even if you're not exactly where you want to be on margins or rates, even if you had to spend a little bit more than what you wanted to maximize appraisal value on the rehab of that property. Think that in some ways with that buy and hold strategy, time will heal some of those wounds. And that is going to be your best friend in real estate investing, because the fact is you don't know everything. There's tons of things that are going to change. They could fill volumes with the things of books, with the things that you don't know. And you're going to have to rely upon some time and some grace from the God of investing to make sure that you get out of this okay. And you will get out of it okay, because there is time to allow for adjustment factors to work their magic. In all likelihood, rent will continue to grow at a rate of 3 to 5% for the foreseeable future. In all likelihood, your home value appreciation will grow at a minimum of 4% over the course of time. That means your real estate investment will be worth double of what it is if it just grows at 4% in about 10 years, in about 11 years, actually. And that's an amazing thing to think about, but it's how this whole strategy can work for you over the course of time if you're patient.
Yeah, outside of what we witnessed in 2008, 2009 with the housing crash, there's been very few times where people have been able to buy properties at the right price and lose on that deal, right? And so I think, I've said this before in this podcast, but it rings true almost every time I turn around and analyze a deal, is that you make your money when you buy it, right? And so if you buy right, very seldom are you going to be at significant risk for loss. And that's the most important thing when you talk about patience and endurance. Patience and endurance isn't after you buy the asset alone. It's also in selecting the right asset to purchase up front, right? Don't get in a hurry. There's no need to feel like, oh, all the good deals are disappearing. I've got to hurry up and buy something. Well, that is a recipe for loss. Or a recipe for a lot of pain over the course of time while you wait to heal those wounds. Don't rush into real estate investing. And in fact, one piece of advice that I think we both give to almost everyone we encounter, we gave this to a group of college students, a few weeks ago, is that your first investment property should be the home that you live in. It's the lowest risk investment you can possibly make. And it also stands to be the best investment long-term you'll ever make, because you don't feel the need to hurry up and flip it. You're not worried about who's living in the home. You're living in the home, right? invest your money in a home that you live in first and get a taste for what it's like to own real estate. You learn so many valuable lessons there, and then move on to owning fix and flips or buy and holds. We love the buy and holds. If you have any questions or ever need advice on, issues you're concerned about with buy and hold, we're definitely here to help you with that. HomeProp is one of the best property managers around, and we've got tons of experience managing tenants, helping landlords maximize cash flow and making that buy and hold strategy work. And so call on us, email us, reach out anytime, because we can help you be successful in any strategy that you decide to implement as a real estate investor.
I love the commercial. But it's the truth, right? We've helped hundreds of investors make these kinds of decisions. We've helped them in fix and flips, and we've helped them in buy and hold strategies. So we can do the same thing for you. And goodness, it's getting ready to be a brand new year. You're probably setting goals already for yourself. I bet if you're at all like us, that expanding your real estate portfolio is on one of your goals for 2023. And I hope that you make that happen. I hope this is the year where you are patient, of course, and you look for the right deal, but that it's also the year where you actually press go and engage in that strategy. And so very early in the year, we're going to have a podcast that discusses the actual evaluation of real estate. So you can see with us the flow and the financials behind evaluating properties from these different standpoints. We'll show you what we do. It's just one of many things that will be available to you online. But I look forward to sharing that with you guys in the new year. So yeah, where they can go to learn more, they can come right back to this podcast starting in 2023, and we'll give you some great information about that.
Tune in next week where we talk about our crystal ball for 2023, right?
That's going to be awesome.
Yeah.
We'll see. And I love these episodes, right? Because we get to see whose is going to come true. We'll put it down in perpetuity on this podcast, and then we'll compare notes at the end of 2023 to see which of us were the best fortune tellers.
Yep.
So
we've only got a couple weeks to get back down to 5%. So we'll see what the interest rates do.
Oh man, I've got so much money. I've got $10 riding on the fact that they'll stay above 6% for the rest of the year. So let's see if that big investment comes true.
Might be close.
I know. Hey, it's been a blast, Chase. Always is. Look forward to next week.